welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. Now, we all know that inflation eats away a part of your hard-earned returns. But did you realize that actual lifestyle inflation is much, much higher than the consumer price index increase that's always in the headlines? In fact, going by some estimates, inflation that's impacting HNIs or the affluent urban Indian is as high as 12%. So this week we asked the question, is it really possible to create an inflation-proof portfolio? And if yes, then how do we go about creating it? Well, joining me to answer that is Feroz Aziz, Deputy CEO of Anand Rathi Private Wealth. Feroz, always a pleasure to have you on the show. It's good to have you back. So, your sense first on this whole inflation conundrum, because whenever wealth managers like yourselves are advising clients as to where to put their money, you always take inflation into account, right?
Absolutely. See, I think the first baby step of investing is inflation, because if you don't store your money efficiently enough that it grows more than the commodity you wish to buy, you're better off spending the money rather than storing it and then buying stuff later. So inflation becomes the first baby step of investing. So you can't go wrong with the estimate. So that's where we started deliberating whether the high-frequency CPI, which comes on a very regular basis, is that relevant, and what is the consumption pattern the government assumes, and is that a right assumption? And then we were surprised that it was incorrect.
So what are your own numbers telling you, the mathematics that you've done, and what is the figure that you've arrived at?
So when we did a large piece of information gathering, we realized that 12.13% is what came as inflation, depending on what individuals spend on. Of course, it can range between 11 to 13, but it's significantly upwards of at least the double-digit number.
So how do you get to this number of 12%?
So what we did was we tried to understand people's spending patterns in urban India, like you said, or an HNI, high net worth individual. What do they spend on? And then we made a list of 10, 12 items which they spend on, like brands, like club memberships, by air travel, banquets for their child's wedding, could be higher education, sophisticated medical care, because that's also inflating at 16-17%. So if you put equal weightage, assuming that an individual spends on these a reasonable amount of money, then that's how we arrived at 12.13%.
So now we come down to the tricky question that yes, everybody wants an inflation-proof portfolio, and it's perhaps easy to say that go invest in equity because equity over a long period will give you better return. But I guess the critical question is the right mix. At what age, at what sort of profile do I need how much equity, how much debt? So maybe we can classify this for the young investors, the middle-aged investors, and then for the more sort of senior investors. How do you create this portfolio?
See, I think, if age is going to be one large determinant of how you're going to allocate between risky and non-risky asset classes. First, it's very important to understand that there are two risky assets, or growth assets as we could call them on a positive note. That's equity and real estate are the two growth assets. And
is real estate still growth?
Yeah, probably
after the last few years.
At least looking at the contemporary situation, it's not growth, it's degrowth maybe. But yeah, from a characteristics perspective of the asset class, it is a growth asset. And on the safety or protection is debt and gold. So I think a person who's at the age of 30 should at least have 70 to 80% of his money in growth assets, real estate and equity. Looking at the current situation, largely skewed towards equity and not skewed towards real estate. And the other 20-30% could be in protection assets, which is debt and gold, to my mind. And as you progress every five years, you could probably reduce your risk assets portion by about 5% and move that into protection as a thumb rule. I think that's a good way of mechanically managing your money rather than rediscovering this question more or less. So at the age of 30, you start with 80 and 20 and then move down 1% every year. Maybe in the pockets of every 5 years, you could bring down your risk assets by 5%. So by the end of getting to 50, you would have brought down your equity allocation to almost about 50-55.
It's interesting, we're speaking at a time when equity markets are back to their historic levels, historic highs. So does this thumb rule work even now in the current market situation where we've already seen such a big rally?
See, I personally think over long periods of time, you want your equities to give you large portions of return. 10-15% this way, that way as a start point will not change your return per annum over long periods of time. So if you actually put some number, if you would have let go of 10% rally, for example, which has happened over the last couple of months, your return on a 10-year basis will change by 0.3%.
Okay.
Now, so for a short-term investor, it's very relevant to actually see where we are entering. But for a long-term investor, especially when he's doing his life's planning and goals, I think on a per annum basis, the IRRs wouldn't change too much, or the return per annum wouldn't change too much.
Okay. All right. We'll take a break on that note. On the other side, we get down to specifics and get down to actual equity breakdown. If you're looking at mutual funds or vis-a-vis direct equity exposure, what are the funds that you need to have in your portfolio to make it inflation-proof? Back after the break.